So, Raoul, you took a massive swing at crypto at the same time like gold bulls were feverish, and they gave you a lot of crap for it in the legacy market for taking a really aggressive and I'd say progressive position on Bitcoin being a higher beta play on the same idea. Can you expound on like why you made that decision and what gave you the conviction for it?
When I got started kind of March, I was short equity markets, betting they were going to go down. I'd started buying Bitcoin. I bought gold and I was long bonds, expecting rates to go to zero, which is essentially all played out. So it was an amazing period of time. Then we kind of settled into trade. I closed out my short positions in equities because they're always dangerous when the central bank's printing unprecedented amounts of money. And I thought, okay, if they're printing unprecedented amounts of money, how do you capture that? You know, what's the trade to be done? And the trade was this debasement of currency and the kind of people wanting to protect their capital. So I was still with gold and Bitcoin, and basically I just started toying around with the charts of Bitcoin versus ... and looked at anything. And it was like, well, it's actually outperforming everything on Earth. And at the time, it hadn't started fully outperforming for this cycle, the central bank balance sheets. But other than that, it was starting to break down versus gold, equities, NASDAQ, you know, copper. I mean, you name it. And I was like, I called it the supermassive black hole, that I saw that it had a high probability of outperforming literally every asset on Earth, and therefore it was going to suck in all the capital. And so I just closed my gold position, went 100% into Bitcoin at that point, and then eventually broadened out into other digital assets.
Yeah, I think that one of the things that interests me there is a lot of people from legacy markets, been around a long time, they saw Bitcoin explode from 0 to 20K, and they're like, all right, this is game over. And, you know, it was one of those once-in-a-generation type bubbles, and then off you go to the next thing. And some people stuck around and were like, no, this is going to still play a role in the macro landscape the next time that this is an appropriate trade. What gave you the conviction to fade the like tulip concept versus the like this is going to stick around and be a part of real macro?
So I'd written in 2013 an article about stock to flow. So I kind of thought, well, if Bitcoin is digital gold, then it should have the same attributes. So I kind of figured out on a rough kind of back of a fag packet piece, calculation is, okay, how much gold is above ground? How much gets mined? How much do we know is in discoverable sources below the earth? And then kind of back that out into Bitcoin. And I figured out with gold at the time is about 1,500. Bitcoin should be at 1 million. And that was, I thought, okay. So, and it was at the time, it was at 200 or something stupid. So I'm like, okay, this is the wrong price. So that was the start. I probably wrote the first ever article about kind of macro valuation of Bitcoin. Then obviously Plan B independently and brilliantly put together his stock to flow model, which even if it's not 100% perfect, gives us a conceptualization of how this might work because of this halving and the scarcity of the asset. But it was really discovering Metcalfe's law and how it applied to networks that gave me an understanding of how big this really could be. And once you look at things that are network adoption models, you tend to find they don't mean revert like a commodity that tends to have, not enough supply, which is going on right now. Supply meets it, collapses, right? This can't happen in crypto just by definition, particularly in Bitcoin. And then when you look at it, all of these kind of events, they look like bubbles, but they're all part of an exponential trend. So once you put it on a logarithmic chart, it actually looks pretty normal. And that's how you have to get a head around it. And humans don't think in non-linear terms. It's really hard for us. So, if you take 20 linear steps out of my office here, I get to the other side of the lounge. If I take 20 exponential steps, I go around the world twice or something stupid. So, we can't get our heads around this. But I started looking at those charts, figuring out how network effects apply to this, and then realized the only mean reversion is probably to something like the 3 or 5 year exponential moving average, and that's it. So it's just an exponential curve that keeps going, but flattens out over time as the network effects get more saturated.
Up only.